Welcome to our channel. Today we're diving into a topic that's crucial for anyone looking to grow their wealth through investing. We'll be discussing the 5 biggest mistakes investors often make. And trust me, whether you're just starting out or you've been in the game for years, these pitfalls can cost you dearly. In this video, we'll break down each mistake, providing you with insights and strategies to avoid them. From emotional decision-making to neglecting proper research, we'll cover it all. Our goal is to equip you with the knowledge you need to make informed choices and enhance your investment journey. Why is this important? Well, understanding these common missteps can be the difference between financial success and setbacks. Many investors fall into traps that could have been easily avoided with a little awareness and preparation. By the end of this video, you'll not only recognize these mistakes but also learn how to sidestep them, setting yourself up for a more prosperous future. So, whether you're a novice eager to learn the ropes or an experienced investor looking to refine your strategy, stick around. We promise to keep things engaging and informative, ensuring you walk away with valuable insights that can make a real difference in your investment approach. Let's get started and empower your financial journey together. Mistake number 1. Emotional investing. Emotional investing is one of the most common pitfalls that can derail even the most seasoned investors. When fear and greed take the wheel, rational decision-making often goes out the window. For instance, during market downturns, fear can prompt investors to panic sell their assets, locking in losses instead of allowing their investments to recover. Conversely, when the market is booming, greed can lead to impulsive buying, often resulting in overpaying for stocks that may not have sustainable growth. Let's consider a couple of scenarios. Imagine an investor who, after hearing news of a market crash, hastily sells off their shares in a panic. This decision is driven by fear, and while it may seem like a protective measure, it often leads to regret when the market rebounds. On the flip side, another investor might jump into a trending stock simply because everyone else is doing it, driven by the fear of missing out. This can lead to significant losses when the hype fades. So, how can you maintain a rational mindset when investing? First, establish a clear investment strategy based on your financial goals and stick to it, regardless of market fluctuations. Second, practice mindfulness and take a step back when you feel strong emotions influencing your decisions. Lastly, consider seeking advice from financial professionals who can provide objective insights. By recognizing the impact of emotions and implementing these strategies, you can make more informed, rational investment choices that align with your long-term objectives. Mistake number 2. Lack of research. Investing without adequate research is like navigating a ship without a compass. It can lead you into treacherous waters and result in significant financial losses. Understanding market trends and company fundamentals is crucial for making informed investment decisions. Without this knowledge, you risk investing in companies that may not have a solid foundation or are operating in declining industries. So what does thorough research entail? First, it's essential to familiarize yourself with market trends. This includes understanding economic indicators, industry performance, and consumer behavior. By keeping an eye on these factors, you can identify potential opportunities and avoid sectors that may be on the decline. Next, dive into the fundamentals of the companies you're considering. Look at their financial statements, earnings reports, and growth potential. Tools like Yahoo Finance, Google Finance, and various stock analysis platforms can provide valuable insights into a company's performance and outlook. Additionally, reading analyst reports and following reputable financial news sources can help you stay informed about market developments. Before making any investment decisions, it's vital to conduct thorough due diligence. This means taking the time to gather information, analyze data, and understand the risks involved. Don't rush into investments based on tips or trends you hear from friends or social media. Instead, arm yourself with knowledge and make decisions based on solid research. By doing so, you'll be better positioned to make wise investment choices that align with your financial goals and risk tolerance. Mistake number 3. Timing the market. Trying to time the market is a common mistake that can significantly hinder your investment success. The reality is that market movements are unpredictable, influenced by a myriad of factors including economic data, geopolitical events, and investor sentiment. Attempting to buy low and sell high based on short-term fluctuations often leads to missed opportunities and increased risk. Consider the historical example of the dot-com bubble in the late 1990s. Many investors tried to time their entry into tech stocks, believing they could capitalize on the rapid growth. However, when the bubble burst in 2000, those who had jumped in at the peak faced devastating losses. Similarly, during the 2008 financial crisis, countless investors attempted to time their exits, only to find themselves on the wrong side of the market when it rebounded. Instead of chasing short-term gains through market timing, it's far more effective to adopt a long-term investment strategy. This approach allows you to ride out market volatility and benefit from the compounding effect of your investments over time. By focusing on quality assets and holding them through market cycles, you can reduce the stress and uncertainty that comes with trying to predict market movements. In essence, successful investing is about patience and discipline. Rather than worrying about when to buy or sell, concentrate on building a diversified portfolio that aligns with your financial goals. This way, you can weather the ups and downs of the market while positioning yourself for long-term growth and success. Mistake number 4, over-diversification. While diversification is a key principle in investing, over-diversification can actually work against you. Spreading your investments too thinly across a multitude of assets can dilute your potential returns and make it challenging to track your portfolio's performance. When you own too many different investments, it becomes difficult to identify which ones are truly contributing to your financial goals. For example, if you have a portfolio filled with dozens of stocks, bonds, and mutual funds, the impact of any single investment on your overall returns may be minimal. This can lead to a situation where you're not fully capitalizing on the growth potential of your best-performing assets. Instead of maximizing gains, you may find yourself with a collection of mediocre investments that fail to deliver significant results. Finding the right balance in a diversified portfolio is essential. A well-structured portfolio typically includes a mix of asset classes such as stocks, bonds, and real estate, but it's important to limit the number of holdings within each category. Aim for a concentrated approach that focuses on quality investments rather than quantity. By selecting a handful of strong, well-researched assets, you can better monitor their performance and make informed decisions about when to buy or sell. Remember, it's not about how many investments you have, but rather how effectively they align with your financial objectives. Prioritize quality over quantity, and you'll be on your way to building a more effective and rewarding investment portfolio. Mistake number 5, ignoring fees and taxes. One of the most overlooked aspects of investing is the impact of fees and taxes on your overall returns. Many investors focus solely on the potential gains of their investments, but failing to account for these costs can significantly erode profits over time. High management fees, trading commissions, and other expenses can eat away at your investment growth, leaving you with less than you anticipated. Understanding investment fees is crucial. For instance, actively managed mutual funds often come with higher fees compared to index funds. While the allure of professional management may seem appealing, these costs can diminish your returns, especially in the long run. It's essential to scrutinize the fee structure of any investment option you're considering and choose low-cost alternatives whenever possible. Look for index funds or exchange-traded funds, ETFs, that offer broad market exposure with minimal fees. In addition to fees, tax implications should also be a key consideration in your investment strategy. Different investment accounts, such as tax-deferred retirement accounts or taxable brokerage accounts, can have varying tax consequences. For example, holding investments in a tax-advantaged account can help you defer taxes on gains, allowing your money to grow more efficiently. By being mindful of both fees and taxes, you can make more informed investment decisions that enhance your overall returns. Prioritize low-cost investment options and consider the tax implications of your choices to maximize your financial success. Remember, every dollar saved on fees and taxes is a dollar that can work harder for you in the market. As we wrap up today's discussion, let's quickly recap the 5 biggest mistakes investors often make and how to avoid them. First, we explored emotional investing, highlighting how fear and greed can lead to poor decisions. Remember to maintain a rational mindset and stick to your strategy. Next, we discussed the dangers of lack of research, emphasizing the importance of understanding market trends and company fundamentals. Always conduct thorough due diligence before making any investment. We then address the pitfalls of trying to time the market, which can be detrimental to your success. Instead, focus on a long-term investment strategy that allows you to ride out market fluctuations. Following that, we talked about over-diversification, reminding you that quality investments are more valuable than quantity. Finally, we examined the impact of fees and taxes, urging you to choose low-cost options and consider tax implications in your investment decisions. The key takeaways for your investment journey are clear. Stay informed, be patient, and prioritize quality over quantity. By avoiding these common mistakes, you'll be better positioned to achieve your financial goals. If you found this video helpful, we encourage you to subscribe to the Wealth in Minutes channel for more insightful content. Don't forget to like and share this video with fellow investors who might benefit from these tips. Explore our related content for deeper dives into each topic we discussed today. Thank you for watching, and here's to your successful investing journey.